Hello, this is Mel Holsworth again, and I'm covering this presentation for superannuation trustees for the period ending 30th of June 2012 as an update. Normal disclaimer, of course, that this is general advice and doesn't take into account your specific circumstances. Be aware that the laws change frequently, and so you need to seek specialist and timely advice in making your decisions for the future. Of course, we're happy to take on that advice, and so if you need any specific instructions, please contact us. This is another presentation in the contributions and reserving section for the year, and we're dealing most especially in this section with concessional contributions. I invite you to look at the other presentations relating to timing and reserving, non-concessional contributions, contributions in kind, payment of self-managed super fund out-of-pocket expenses, the new 30% contributions tax for those earning greater than a notional amount of 300k, and government co-contributions. So what is a concessional contribution? Well, concessional contributions are those contributions that attract the tax deduction to the payer and are taxable income to the superannuation fund. Now, in order for a concessional contribution to be a tax deduction, it must meet three tests. These tests include that the receiving superannuation fund is a complying fund, that the member meets the tests relating to age and the work test, and of course that the member is an employee of that employer, or if they're self-employed, meets those tests. Now I have another section that deals with age-related and work tests, and have another presentation on that, so if you have some queries relating to the age-related and work test areas, I'd invite you to look at one of the other presentations. So in order for a concessional contribution to be received by the superannuation fund, it must receive a notice of intent. We generally send them out when we receive your superannuation file for you to complete. It's that document where you put your name, the names of all the members, and you need to write down what are the various contributions that have come into the fund in the last year. This is the only way that Heather can determine whether the contributions are coming in are concessional or non-concessional, and so it's important to get the notice of intent right. Of course, there is a cap again this year. It's ludicrous that the government actually has a limit on this. That's short-sighted, that they want to discourage the Australian public from making contributions to provide for their financial future, so they can be self-reliant rather than depending upon the public purse and Centrelink upon their retirement. Nevertheless, for the years ended 30th of June 2010 and 2011, the concessional contribution cap was $25,000. Then we received a bonus for this current financial year for those who are over the age of 50, who have a member balance of less than 500k. The cap for this current financial year is $50,000. Then starting the 1st of July 2012, it decreases back to $25,000 again. Now, the age of 50 years is as at the 30th of June in that income year, and the member balance of 500k is as per the member balance on the 1st of July of that financial year. If you're over the age of 50 with a member balance of greater than 500k, the cap hasn't changed, it still continues at 25k. For those who are under the age of 50 years with a member balance of less than 500k, the cap for 2012 continues at $25,000 a year and remains unchanged in the future. There is a promise by the government that these caps will be indexed, and maybe even a promise from Minister Shorten that 2014 onwards the cap will go back, for those who are over the age of 50, will go back up to $50,000 a year, or maybe even $55,000 by the time it comes around, if you take into account CPI increases. But of course, politicians' promises are taken with a huge grain of salt. Another last point I'd like to make in this regard is that mandatory 9% super guaranteed contributions do have a maximum cap as well, so employers are not required to pay greater or 9% on a employee's salary if that employee's salary exceeds $43,820 a quarter, or $175,280 per annum. Now they can make the 9% contribution if the salary is greater than that, but by law they're not required to. So just an interesting thing for you to be aware of if you're negotiating a salary package. Be aware that of those thresholds, because there's a non-requirement for the mandatory 9% super to be paid on salaries greater than $43,820 per quarter. Thank you very much for listening to this presentation.